In this video, traders, we're going to look at how do banks or FX firms make money in FX. Stay tuned. Hey traders, warm welcome to you. So really the title of this video is slightly misleading. How do banks or FX firms make money in FX? I'm talking from a dealer or a trader's perspective. So these bank traders, bank dealers, big FX firms, it seems like these guys make a lot of money. I want to note the distinction between a dealer, okay, and a trader. A trader like you and I watching this, we don't have a flow of money or orders coming into us. We have to speculate on the future direction of the instrument we're trading. So let's say we're trading US dollar JPY, he's trading at 113. If we go long, it goes up to 115, whoopee-doo, we make money. It goes down to 110, we lose money. That's it, we're just speculating on the future direction of price, short term, long term. Now, if we are a dealer, and some people do call themselves traders still, but a dealer is someone who is in the middle of order flow, and it's a different game. This is how these guys making their money as opposed to pure speculation. Let's have a look how the deal might work. So we've got USD JPY sitting trading at 113. The guy sitting on the phone comes in and gets an order, and the guy says, you know what, I want to buy $1 billion dollars worth of yen, right? And it's currently trading at 113. In the interbank market, and this is hypothetical, but just the order of magnitude is about right. In the interbank market, we've got, you know, a bid price of 112.999, say, and an ask price of 113.001 or something like that. Really, really tight. Hardly any spread at all. It's a real thick major, of course. So if you want to convert USD into JPY, you're getting a decent spread. But the guy on the phone, okay, says he's got $1 billion or whatever the number may be. Dealer says, yeah, sure, we can do that for you at a price, current price of 113.25, right? And the guy says, cool, no problem, done. Or it might be more than that, but let's just say 113.25. I can get you, you know, $1 billion will get you a rate of 113.25. So you get every dollar you spend, you get 113, whatever that is, times a billion, you get the point, 113 billion, 25, 250 million. The point is, the deal's done, right? Hangs up the phone, done, whatever you say, done. You've done well the money, good a client, got it on account, whatever. Deal's done. Now, the dealer has an opportunity. If it's currently trading at 113, right? He's got from 113 all the way up to 113.25 to come out at break even. The price can go anywhere between 113 and 113.25 and he's made money. He has effectively bought at 113.25. Now, he has sold his client, but he's on the other side of the deal. So if he can buy the actual yen in the market right now at 113, he's made 25 pips times by that size. So straight away, he can make a quick bit of money. And that's how these guys make money. Of course, they're there to provide a service, they need to be compensated for that. But that's how they buy a service. They're buying at 113. They're selling it to that guy at 113.25. They're making their 25 pips times by that decent size. That's a lot of money. However, they can speculate a little bit more. Perhaps they've got a few orders coming in. Perhaps they've got orders coming in and someone is on the other side of the trade. He's selling yen and they quote that guy at 112.75. So they're making an even bigger spread. Or perhaps there's half the money, or perhaps this, or perhaps that. But the point is, what he can do is he can speculate now with that cushion. He's got a 25 pip cushion. He can say, and this will all be commercially outlined and stuff. He's not going to be trading on a whim, you hope. Perhaps he's allowed to take £500 million worth of risks. So he closes out £500 million. He banks that 25 pips. He's sold those to that guy at 13.25. He's bought them himself at 13. All good. He's banked that. There's a nice bit of profit there. He can play with this extra little money and perhaps hold it for a further fall. If he believes that yen is a little bit overpriced, it's come up to resistance, whatever, the same kind of thing that we do, the further that falls, the better margin he's made on the deal. If it goes down to 112.25, let's say, he's suddenly made 100 pips on that deal. as opposed to just 25 pips. But if it doesn't and it creeps back up, and let's say it creeps back up and his stop loss is 113.20, assuming the liquidity is there, I'm going to assume that it is for this, it creeps back up to 113.20, he can close that. He's still made 5 pips, so they don't call it pips, they call it in different kind of thing like basis points. But let's just keep it like this for you and I, because we work in pips. Pips, he's made 5 pips on that deal anyway, so he's still made money on the deal, and assume he's closed half right off the bat, he's made money. So they've got that cushion there. So dealers on banks and FX firms that are doing these kind of deals, that's how they will operate. They'll have that cushion there already. And this is, obviously there's more ways, and I'm just sort of touching on this, that they make money. They make money on the spread. They're facilitating a two-way flow between, and if they've got people on both sides of the coin, they just widen that spread tightly. They take a little bit of risk. They do a lot of paperwork and stuff, and they're compensated for it. But they have got the opportunity. If they've just done a deal and sold that yen to someone at 113.25, current price to them is 113, they think it's going lower, they can hold it, and if they're right, they've still got a cushion. If they're wrong, it can still come out 113.20. They've still managed to buy something at 113.20. They've sold on for 113.25. You get the idea. So there's a difference between dealers and traders. Obviously, they're going to have leeway depending on the commercial attitude of the company, directors, etc. Maybe they don't. Maybe all they can do is quote the price that they get plus the commission they offer, and they don't internally then have to kind of take any risk. Maybe they just have to deal. You just don't know. But that is one way that they can kind of make some money out. And from a customer's perspective, you are not really that bothered. If you're doing a deal, as long as that's reasonable and you're not paying over the odds for it, you just want to make a phone call and get it done. You're paying somebody to do it for you, to do the trade for you, to do the clearing, to get the money into your account. You haven't got time to be messing around, opening things. So you can see why that's valuable to the customer to do that. But then you can see why the dealer on the other end might have a little play with it and go, well, let me just see. If it starts to rock back, I'll just hold off, because when you've got decent size like that, every little movement is going to add up to a decent bottom line. So anyway, guys, that's how dealers in the FX firms and maybe some of the banks make money when they're dealing FX currency between customers and a little book like that. All right, guys, take care. See you next one. Bye-bye.